In the spring of 1933, a farmer in Iowa stood on his front porch and watched his neighbors gather at the end of his driveway. He was about to lose his farm. He had fallen behind on his mortgage during the Depression, unable to make payments when crop prices had collapsed to levels that made farming economically impossible. The bank had foreclosed. A sheriff's auction was scheduled to sell the farm to the highest bidder. His neighbors had come to the auction. They bid. The first bid came in at $1. When other bidders tried to raise it, the crowd grew menacing. No other bids were accepted. The farm was sold for $1 and a few additional cents and immediately returned to the farmer who had owned it. These were penny auctions, and they were happening across the Midwest in 1932 and 1933. Farmers whose neighbors refused to let the bank take their land, who organized to make the legal process of dispossession unworkable through collective resistance, who threatened violence against anyone who bid against them or against the sheriffs who tried to enforce the foreclosure orders. Some judges suspended foreclosure proceedings for months under explicit or implicit threat of violence. Iowa, Minnesota, and several other states declared moratoriums on farm foreclosures. The situation was genuinely close to insurrection. The dispossession of families who had farmed their land for generations by banks that were calling mortgages that could not be paid in a collapsed economy was producing a level of social fury that the political system recognized as dangerous. The response, when it came, was federal. The Homeowners Loan Corporation, established in June 1933, was the first major federal intervention into the mortgage market in American history. It refinanced more than 1 million failing mortgages, preventing the foreclosure of homes across the country and stabilizing a housing market that was in freefall. The Federal Housing Administration, established in 1934, went further. It created the framework for the modern mortgage that Americans still use today. The long-term, fixed-rate amortizing loan that allows families to purchase homes with modest down payments and predictable monthly payments. Before the FHA existed, this kind of mortgage did not exist, and before the FHA existed, the experience of homeownership in America was dramatically more precarious than it became after the federal government entered the housing market. This is the story of what homeownership actually looked like before federal housing programs existed, of what the Depression did to the families who owned homes and the families who wanted to own them, of the political crisis that forced federal intervention, and of the long-term consequences of the specific way that intervention was designed, including the racial exclusions that shaped American housing for generations. To understand what homeownership meant before 1933, you need to understand the mortgage market of the pre-Depression era, because it was almost unrecognizably different from the mortgage market that exists today. The standard mortgage in the 1920s was a short-term, interest-only loan. A borrower who wanted to purchase a home typically put down between 40 and 50% of the purchase price in cash and borrowed the remainder for a term of 3 to 5 years. The loan was interest-only, meaning that the monthly payments covered only the interest accruing on the principal, and the entire principal balance was due at the end of the loan term in a balloon payment. This structure made homeownership accessible only to people with substantial savings for a down payment, and it made the sustainability of homeownership dependent on the borrower's ability to refinance the loan when it came due. A borrower who had made their interest payments faithfully for 5 years, but could not refinance at the end of the term because the lender had become more cautious or because credit conditions had tightened, faced the loss of their home and their entire down payment. The refinancing risk was understood by borrowers, but in the economic environment of the 1920s, it seemed manageable. Home values were rising. Credit was available. A homeowner who needed to refinance at the end of a 5-year term could generally do so on acceptable terms, because the lender was looking at a property that was worth as much or more than when the original loan was made, with a borrower who had demonstrated their ability to make regular payments. The Depression destroyed these assumptions systematically and simultaneously. Property values fell dramatically as the economic collapse reduced demand for housing and as forced sales from foreclosures flooded the market with distressed properties. Credit contracted sharply as banks that were themselves in financial distress stopped making new mortgage loans and refused to refinance existing ones. And incomes fell as unemployment spread, making it impossible for borrowers who had been able to service their interest-only payments to continue doing so. The combination of falling property values, unavailable credit, and collapsing incomes produced a foreclosure crisis of unprecedented scale. In 1933, at the depth of the Depression, approximately 1,000 homes were being foreclosed every single day. 1 in 5 mortgaged homes was in default. The savings institutions, building and loan associations, and commercial banks that had made the loans were themselves in crisis, with defaults on their mortgage portfolios threatening their own solvency. The human consequences of this crisis were severe and visible. Families who had worked for years to save a down payment and purchase a home, who had made their payments faithfully as long as they could, who had done everything right by the standards of the financial culture of the 1920s, were losing their homes to banks that had no choice but to foreclose because they needed the cash from their loan portfolios to survive. The Hoover administration's response was limited and largely ineffective. The Federal Home Loan Bank system, established in 1932, was designed to provide liquidity to the building and loan associations that were the primary mortgage lenders for working-class homeowners. It allowed these institutions to borrow from the Federal Home Loan Banks when they needed cash, using their mortgage portfolios as collateral. But the system was too small, too slow, and too limited in scope to address the scale of the crisis. The penny auctions and the mortgage moratoriums that followed reflected the political reality that the existing system was failing in ways that were producing social instability and that the federal government needed to do something more substantial than the Hoover administration had been willing to attempt. The Homeowners Loan Corporation was the Roosevelt administration's first major response. The HOLC was authorized to purchase defaulted mortgages from lenders and refinance them into new loans with more sustainable terms. Longer maturities of up to 15 years, lower interest rates, and crucially, fully amortizing structures in which each monthly payment covered both interest and a portion of the principal, so that the loan would be fully paid off at the end of the term rather than coming due in a balloon payment. The HOLC purchased approximately 1 million mortgages between 1933 and 1936, representing approximately 1 in 5 of all mortgaged homes in the country. For the homeowners whose mortgages were purchased and refinanced, the corporation provided a genuine lifeline: lower payments, predictable amortization, and the end of the refinancing risk that had made pre-depression homeownership so precarious. The HOLC also conducted the first systematic appraisal of residential real estate across American cities, rating neighborhoods by their perceived riskiness as mortgage investments. These appraisals, which became the basis for what would later be called redlining, evaluated neighborhoods not just on the physical quality of the housing but on the racial composition of the residents. Neighborhoods with significant black populations were rated as high risk, coded red on the maps that the HOLC produced, and treated as ineligible for mortgage refinancing on favorable terms. The racial rating system was not incidental to the HOLC's operations. It was systematic, applied across every major American city, and it produced maps that became the template for subsequent federal and private mortgage market decisions about which neighborhoods were considered creditworthy and which were not. The HOLC's appraisal methodology effectively codified racial segregation into the federal mortgage market at the very moment that the federal government was entering that market for the first time. The Federal Housing Administration, established the following year in the National Housing Act of 1934, extended and systematized the federal role in the mortgage market. The FHA did not make mortgage loans directly. Instead, it insured mortgage loans made by private lenders against default, guaranteeing that if a borrower failed to pay, the FHA would compensate the lender for their loss. This guarantee dramatically reduced the risk for lenders, which allowed them to offer mortgage loans on much more favorable terms than had previously been available. Longer maturities of up to 30 years, lower down payments, and the fully amortizing structure that the HOLC had pioneered. The FHA mortgage, with its long-term, low down payment, and predictable monthly payments, was the instrument that made mass homeownership possible in America. Before the FHA existed, purchasing a home required a substantial down payment and acceptance of significant refinancing risk. After the FHA, a family with a modest down payment and a steady income could purchase a home and pay for it in predictable installments over 30 years, building equity with each payment. This transformation was genuine and significant. The homeownership rate in the United States was approximately 44% in 1940. By 1960, it had risen to 62%, driven primarily by the FHA mortgage and by the related VA Home Loan Guarantee Program that provided similar terms to returning veterans. The mass homeownership that Americans have come to regard as a defining feature of middle-class life was created in the decade and a half after 1934 by federal programs that made the modern mortgage available to a much larger fraction of the population. The racial exclusions embedded in the FHA's underwriting guidelines were the shadow side of this achievement. The FHA's underwriting manual, which governed the terms on which the agency would insure mortgages, explicitly incorporated the HOLC's racial rating system. The manual stated that if a neighborhood was to maintain stability, it was necessary that properties shall continue to be occupied by the same social and racial classes, and it rated neighborhoods with racial integration or black residents as high risk for insurance purposes. The practical consequence was that the FHA systematically refused to insure mortgages in black neighborhoods or for black homebuyers purchasing in white neighborhoods. Private lenders who relied on FHA insurance for their mortgage portfolios followed the agency's lead, declining to lend in areas the FHA would not insure. Real estate agents maintained codes of ethics that prohibited steering minority buyers into white neighborhoods, and suburban developers who built the new subdivisions that were being created to house the post-war baby boom included racial covenants in their deeds that prohibited sale to non-white buyers. The system was comprehensive. The federal government created the financial instrument, the FHA mortgage, that made mass homeownership possible. It also created the regulatory framework that ensured that mass homeownership would be almost entirely white homeownership for the first 2 decades of its existence. The homeownership rate among Black Americans in 1940 was approximately 23%, compared to approximately 46% for white Americans. By 1960, the white homeownership rate had risen to approximately 65% as the FHA mortgage made suburban homeownership accessible to the white working class. The Black homeownership rate had risen only to approximately 38%, a much smaller increase, because the FHA programs that were driving white homeownership were systematically unavailable to Black families. The wealth consequence of this disparity is the same as the wealth consequence of the GI Bill's racial exclusions discussed elsewhere in this series. Homes purchased in 1945, 1950, and 1955 in the suburban communities that the FHA was financing appreciated dramatically in value over the following decades. The families who purchased those homes built equity that they passed to their children, who used it to purchase their own homes, fund their own educations, and start their own businesses. The Black families who were excluded from those communities did not build the same equity, did not pass the same wealth to their children, and the wealth gap that resulted is still measurable today. The Fair Housing Act of 1968, passed 1 week after the assassination of Martin Luther King Jr., prohibited racial discrimination in the sale, rental, and financing of housing. The act was the legal end of the formal exclusion system that the FHA had built. But by the time the Fair Housing Act passed, the FHA and the private mortgage market had been operating on explicitly racial principles for 34 years. The neighborhoods that had been built during that period were segregated. The equity that had accumulated in those neighborhoods was concentrated in white families. The wealth gap that had been created by 3.5 decades of racially exclusive housing policy could not be eliminated by making discrimination illegal going forward. The Community Reinvestment Act of 1977 required banks to lend in the communities where they took deposits, addressing part of the redlining problem by requiring that the credit generated by community savings be reinvested in those communities rather than being exported to more profitable lending markets elsewhere. The act has been credited with increasing lending in previously redlined neighborhoods, though its enforcement has been inconsistent and its effects have been limited by the complexity of proving that a specific lending decision was discriminatory rather than simply reflecting the credit characteristics of the applicant. The current state of American housing, with its persistent racial homeownership gap and its concentration of housing wealth among older white homeowners, reflects both the genuine achievement of the FH in creating mass homeownership and the genuine harm of the racial exclusions that shaped how that homeownership was distributed. Understanding both requires understanding the specific history of the federal housing programs and the specific choices that shaped them. The HOLC's racial appraisal system was a choice. The FHA's incorporation of that system into its underwriting guidelines was a choice. The decision not to include anti-discrimination requirements in either program was a choice. All of these choices had alternatives, and the alternatives would have produced a different distribution of housing wealth across the American population. The Depression-era crisis that produced the federal housing programs was real, and the federal response was necessary. The farmers facing penny auctions and the families losing their homes to foreclosure deserved the relief that the HOLC and the FHA eventually provided. The question is why that relief was designed in a way that provided it primarily to white families while systematically excluding Black families from its most significant long-term benefits. The answer, as in the case of Social Security and the GI Bill and other New Deal programs, is the political accommodation to the racial hierarchy of the South and the broader racial attitudes of the era that shaped every major federal program of the period. The Southern Democrats, who were essential to the New Deal coalition, insisted on racial accommodations as the price of their support, and those accommodations were provided. The consequence is that the federal programs that created the American middle class, the New Deal, and post-war programs that provided Social Security, unemployment insurance, mortgage financing, veterans benefits, and the other building blocks of economic security, were designed and administered in ways that provided those benefits primarily to white Americans while excluding or limiting their availability to Black Americans. This is not incidental to the history of American economic inequality. It is the history of American economic inequality. The racial wealth gap that characterizes the present is not a product of current discrimination alone. It is the product of 70 years of accumulated wealth building by white families that was systematically denied to Black families by the same federal programs that are often celebrated as creating the American middle class. Understanding this history is not a call for guilt or for the condemnation of the individuals who administered these programs. It is a call for historical accuracy about the causes of current conditions. The racial wealth gap has specific causes, and the federal housing programs are among the most clearly documented and most consequential of those causes. The farmer on his Iowa porch in 1933 deserved to keep his farm. The federal programs that were designed to help him were real achievements, and the decision to design those programs in ways that excluded his black counterparts from their most significant benefits was a choice that the country made and that has had consequences lasting to the present day. From the penny auction in Iowa in 1933 to the HOLC of 1933 to the FHA of 1934 to the Fair Housing Act of 1968 to the racial homeownership gap of 2025. That is the full history of federal housing programs in America. The achievement is real. The exclusion is real. The consequences are still being lived. Subscribe if this kind of history is what you are here for. There is a great deal more of it ahead. To understand the full scope of what the federal housing programs created and excluded, you need to trace the specific mechanism of the FHA mortgage more carefully, because the details of how it worked explain both its transformative power and the specific way its racial exclusions operated. The 30-year fixed-rate fully amortizing mortgage that the FHA standardized was a genuinely revolutionary financial instrument. Before the FHA, nothing quite like it existed in the American mortgage market. The balloon mortgages that dominated pre-Depression lending were structurally incompatible with mass homeownership because they required either substantial savings for the balloon payment or reliable access to refinancing, neither of which was available to most working-class families. The FHA mortgage changed the economics of homeownership fundamentally. Consider the difference between a pre-FHA balloon mortgage and an FHA 30-year mortgage for a house priced at $10,000 in 1940. The balloon mortgage would have required a down payment of $4,000 or $5,000, with the remaining $5,000 or $6,000 borrowed at perhaps 6% interest for 5 years, producing monthly payments of approximately $25 to $30. At the end of 5 years, the borrower would face a balloon payment of the full remaining principal, requiring either new savings of $5,000 to $6,000 or a successful refinancing. The FHA mortgage on the same house would have required a down payment of perhaps $800 to $1,000, with the remaining $9,000 to $9,200 borrowed at perhaps 4% interest for 30 years, producing monthly payments of approximately $43 to $45. The monthly payment was higher in nominal terms than the balloon mortgage payment, but the down payment was dramatically lower, and instead of facing a balloon payment in 5 years, the borrower would simply continue making their monthly payments until the loan was fully paid off in 30 years. The crucial difference was accessibility. A family that had saved $1,000 could qualify for an FHA mortgage and purchase a home. A family that had saved $4,000 or $5,000 was required for a balloon mortgage. In 1940, when the median family income was approximately $2,000 per year, the difference between a $1,000 and a $5,000 down payment was the difference between homeownership and renting for most working-class families. The FHA mortgage opened homeownership to millions of families who would never have been able to save a pre-Depression-era down payment. This was a genuine democratization of homeownership in economic terms. But it was not a racial democratization because the program's underwriting guidelines systematically excluded black families from its benefits. The mechanism of exclusion was the neighborhood appraisal system. FHA appraisers evaluated properties not just on their physical characteristics, but on the characteristics of the neighborhood in which they were located. A property in a neighborhood that was rated as declining, which in the FHA's rating system meant a neighborhood with black residents, mixed racial composition, or any proximity to black neighborhoods, received a lower appraisal value and was ineligible for FHA insurance. A black family that wanted to purchase a home in a black neighborhood could not obtain an FHA-insured mortgage because the neighborhood was rated as declining. A black family that wanted to purchase a home in a white neighborhood faced not only the formal exclusion of racial covenants in the deeds and the informal exclusion practiced by real estate agents, but also the additional barrier of FHA appraisers who would refuse to insure a mortgage on a property in a white neighborhood that was being sold to a black buyer, on the theory that the sale itself would cause the neighborhood to decline. The exclusion was comprehensive and self-reinforcing. The FHA would not insure in black neighborhoods because they were rated as declining. The absence of FHA insurance meant that private lenders would not make long-term fixed-rate mortgages in black neighborhoods because they could not sell those mortgages into the secondary market that the FHA's insurance program had created. Without long-term fixed-rate mortgages, black homebuyers in black neighborhoods were confined to the pre-Depression balloon mortgage structure, high down payments, short terms, balloon payments that required refinancing every few years. The black family that was purchasing a home in 1950 in a black urban neighborhood, if they could obtain financing at all, was likely doing so through a land contract or a balloon mortgage from a private lender charging much higher rates than the FHA loans being made in the white suburbs. The land contract was particularly exploitative. It allowed the buyer to occupy the home and make payments, but did not transfer title until the full purchase price was paid, meaning that the buyer who missed a payment could lose the home and all their accumulated payments without any of the legal protections that a mortgage foreclosure would have provided. The wealth consequences of this dual mortgage market were exactly what you would expect. White families buying in the suburbs with FHA mortgages at 4% over 30 years built equity steadily, in homes whose values were being supported and often increased by the FHA's appraisal system. Black families buying in urban neighborhoods with high-rate balloon mortgages or land contracts built equity slowly, in homes whose values were being suppressed by the FHA's refusal to insure there, and faced the additional risk of losing their homes and their accumulated payments if they experienced any financial difficulty. The suburban expansion that the FHA financed was not simply a residential migration, it was a wealth transfer. The federal government was channeling public resources, in the form of mortgage insurance subsidies, into the creation of wealth for white families while simultaneously systematically denying those resources to black families. The homes that appreciated in value in the 1950s and 1960s and 1970s, producing the home equity that became the primary wealth-building mechanism for the white working class, were homes that were financed by federally subsidized mortgages. The homes that did not appreciate or that appreciated less in the urban neighborhoods where black families were confined were homes that had been denied those same subsidies. This is the mechanism of the racial wealth gap that connects the specific decisions made by FHA administrators in the 1930s and 1940s to the economic conditions of black American families in 2025. It is not a vague historical connection. It is a specific causal chain. Federal appraisal policy denied mortgage insurance to black neighborhoods, which denied black families access to the 30-year fixed-rate mortgage, which confined them to expensive short-term financing, which reduced their equity accumulation, which reduced the wealth passed to their children, which reduced the starting position of those children relative to their white contemporaries, and so on for 3 generations. The Fair Housing Act of 1968 made the explicit racial discrimination illegal. It did not undo the 3 decades of wealth building that the exclusion had prevented. The black family that had been denied an FHA mortgage in 1950 had missed the opportunity to participate in the post-war housing appreciation. Making discrimination illegal in 1968 did not give them back the equity they had failed to build in the preceding 18 years. The Community Reinvestment Act of 1977 required banks to make credit available in previously redlined communities. It produced some increase in lending in those communities, though the increase was modest and the credit extended was not always on the same favorable terms as FHA-insured lending had been in the suburbs. The act addressed the symptom of credit denial without fully addressing the structural conditions that had produced it. The subprime mortgage crisis of the 2000s and 2008 was, in part, a consequence of the dual mortgage market that the FHA's racial exclusions had created. Black and Hispanic neighborhoods that had been denied access to conventional prime mortgages for decades became the primary targets of subprime mortgage lenders who were offering high-rate, high-fee mortgages to borrowers who would have qualified for prime conventional mortgages in a racially equitable market. The predatory lending practices that concentrated in these communities, the terms that were unaffordable in the long run, the securitization that made lenders indifferent to the sustainability of the loans they were making, produced a foreclosure crisis that was concentrated in exactly the communities that the FHA had excluded from its program 70 years earlier. The foreclosure crisis of 2008 and 2009 wiped out what equity black homeowners had managed to accumulate, deepening the racial wealth gap at exactly the moment when the broader economy was struggling. Black homeownership rates, which had risen modestly since the Fair Housing Act, fell sharply after the foreclosure crisis and have not fully recovered. The pattern of loss concentrated in black communities was not accidental. It reflected the continuing effects of the geographic and financial patterns that the FHA's racial exclusions had established. Understanding this history is not simply an exercise in documenting past injustice. It is essential for understanding the current housing market, the current racial wealth gap, and the policy debates about how to address both. The current debates about housing policy, including debates about zoning reform, about down payment assistance programs, about fair lending enforcement, and about the provision of affordable housing, are all debates about the current consequences of historical choices. The housing market of 2025 was shaped by the choices made in 1933 and 1934 when the HOLC and FHA were designed, by the choices made in 1948 when Levittown was built with racial covenants, and by the choices made in the decades since when housing policy has addressed the symptoms of those earlier decisions without fully confronting their causes. A housing policy designed to address the racial homeownership gap and the racial wealth gap would need to go further than current policy has gone. It would need to address not just current discrimination, which fair lending laws prohibit, but the accumulated consequences of past discrimination, which current policy largely ignores. The families whose grandparents were denied FHA mortgages in 1950 did not inherit the housing wealth that those mortgages would have produced. Making discrimination illegal in 1968 did not give them back what had been taken from them in the preceding 3 decades. The reparations debate, which has been discussed elsewhere in this series, is partly a debate about exactly this kind of accumulated harm. The specific case for housing-related reparations is among the most clearly documented in the broader reparations discussion, because the mechanism of harm is clearly established, the populations harmed are identifiable, and the current consequences are measurable. Whether political support for such measures can be assembled is uncertain. What is clear is that understanding the history, the specific decisions that were made, and the specific consequences that followed is the foundation for any honest discussion of what contemporary housing policy should look like and what it would take to address the racial homeownership and wealth gaps that those decisions produced. From the penny auction in Iowa in 1933 to the HOLC and the FHA that followed, from the 30-year fixed-rate mortgage that created mass homeownership to the racial exclusions that made it almost entirely white homeownership for 2 decades. From the Fair Housing Act of 1968 that ended formal exclusion to the racial wealth gap of 2025, that is the accumulated consequence of the exclusion that preceded it. That is the full history. The achievement was real. The exclusion was real. The consequences are still being lived in the wealth data, in the home ownership rates, and in the specific communities where the legacy of the FHA's racial appraisal system is still visible in the physical landscape and in the financial circumstances of the families who live there. Subscribe if this kind of history is what you are here for. There is a great deal more of it ahead. The international context is worth examining here, as it has been throughout this series, because the American approach to federal housing policy reflects specific political choices that produce specific outcomes, and comparing those choices to the approaches taken in other countries illuminates what alternatives were available. Most European countries have a larger public housing sector than the United States, reflecting a different philosophical approach to the provision of housing. In Germany, the Netherlands, Austria, and Sweden, public housing, social housing, or cooperative housing represents a significant fraction of the total housing stock, providing affordable housing to a broader segment of the population than the purely market-based approach would accommodate. The United States made a different choice. Rather than building public housing on a significant scale, the federal government chose to subsidize private home ownership through the FHA mortgage insurance program, using the credit guarantee of the federal government to make private mortgage lending more accessible and affordable. This approach was politically appealing because it supported the private housing market and private property ownership rather than creating a government housing sector. The consequences of this choice are visible in the current housing market. The American approach produced high homeownership rates for those who could access the program, but it concentrated housing wealth in the hands of homeowners rather than distributing it more broadly. In countries with significant social housing sectors, housing is treated as a basic need that the government has an obligation to provide at affordable costs regardless of income level. In the American approach, housing is primarily a market commodity, with federal intervention designed to make it more accessible through credit subsidies rather than through direct provision. The racial exclusions embedded in the American approach compounded the distributional problems that any market-based housing system would have produced. By systematically denying the credit subsidies to black families while extending them to white families, the federal housing programs produced a racial dimension to the wealth gap that is more extreme than the economic inequality that the market alone would have produced. A European-style social housing approach might have distributed housing benefits more evenly across racial groups, not because European housing policy was free of racial discrimination. It was not, but because the direct provision of publicly owned housing is more amenable to non-discriminatory administration than a private mortgage market in which lenders and real estate agents have both the incentive and the opportunity to discriminate. This comparison is not an argument for any particular housing policy approach. It is an observation that the specific approach the United States chose, private homeownership subsidized through federal mortgage insurance, had specific distributional consequences that were shaped by the racial politics of the era in which it was designed. Different choices might have produced different consequences. The current housing policy debates in the United States, which include proposals for significant expansion of public housing, for land value taxes that would reduce the speculative premium on land, for inclusionary zoning that would require affordable units in new developments, and for various forms of down payment assistance targeted at first-time and lower-income buyers, are debates about modifying the approach that was established in 1933 and 1934 without fundamentally reconsidering whether that approach is the right one for the conditions of the present. Some of these modifications would address specific inadequacies of the current approach. Down payment assistance programs that reduce the barrier to homeownership for lower-income families address the exclusion created by high down payment requirements. Affordable housing requirements in new developments address the market failure that produces housing shortages in high-cost areas. Fair lending enforcement addresses the discrimination that the Fair Housing Act prohibited but has not eliminated. None of these modifications addresses the fundamental wealth gap that was created by the decades of racially exclusive housing policy that preceded the Fair Housing Act. Closing that gap would require either direct wealth transfers to the families who were harmed, or structural changes to the housing market that would produce different wealth-building opportunities for current and future homeowners regardless of their race. Both of these approaches face significant political resistance. Direct wealth transfers, in the form of down payment grants, land grants, or cash reparations to the descendants of families who were excluded from the FHA programs, face the political opposition that has blocked reparations proposals more broadly. Structural changes to the housing market, such as land value taxes or restrictions on the speculative use of housing as an investment vehicle, face the opposition of existing homeowners and real estate interests who benefit from the current appreciation-based wealth-building model. The political difficulty of addressing these structural issues is itself a consequence of the history. The homeowners who oppose changes to the housing market that might reduce their property values or their ability to pass housing wealth to their children are in many cases the descendants of the white families who benefited from the FHA programs that were denied to black families. Their political power in housing policy debates reflects the wealth that those programs helped them accumulate, wealth that was concentrated in white families by the design choices of the 1930s. Understanding this circularity, in which the wealth produced by racially exclusive policies generates political power that resists reforms that might address the racial wealth gap, is essential for understanding why the racial housing gap has been so persistent, despite the formal legal prohibitions on discrimination that have existed since 1968. The Iowa farmer who stood on his porch in 1933 as his neighbors gathered to defend his farm from the bank deserved the federal programs that eventually saved his home. The federal government that saved his home designed those programs in ways that systematically denied similar assistance to black families who were facing similar crises in cities across the country. And the wealth that the Iowa farmer's family built over the following decades, partly through the appreciation of the home that the HOLC and FHA programs saved and supported, was not available in the same measure to the black families who were excluded from those programs. That is the honest history. The achievement was real. The exclusion was real. And the consequences are still being measured in the racial homeownership gap, in the racial wealth gap, and in the specific communities where the legacy of the FHA's racial appraisal system is still visible in the physical and financial landscape. Subscribe if this kind of history is what you are here for. There is a great deal more of it ahead. There is one more dimension of this history that connects the past directly to the present in ways that are important for understanding the current housing crisis that has developed in American cities over the past 2 decades. The FHA's role in financing suburban expansion after World War II was not just a story about individual home ownership. It was a story about the physical organization of American cities, about where people lived, where jobs were located, and how transportation was structured. The suburban expansion that the FHA financed was accompanied by the construction of the interstate highway system, by the decline of urban public transit, and by the relocation of industrial employers to suburban locations that were accessible by car but not by the transit systems that served urban neighborhoods. The result was a spatial reorganization of the American economy that concentrated economic opportunity in suburban locations and that concentrated the population without access to cars, disproportionately black and lower income, in urban neighborhoods that were increasingly disconnected from those opportunities. This spatial mismatch between the location of workers and the location of jobs has been documented extensively by economists and urban planners, and it continues to affect the economic mobility of urban residents in cities across the country. The workers who live in urban neighborhoods without reliable access to suburban employment centers face longer commutes, higher transportation costs, and reduced access to the highest-paying job opportunities that tend to be located in suburban office parks and industrial areas. The zoning policies that accompanied the suburban expansion compounded these effects. Single-family zoning, which prohibited multifamily housing and apartment construction in most suburban areas, preserved the low density of suburban communities and prevented the creation of affordable housing near suburban employment centers. The result was that the housing near jobs was expensive and primarily available to the white middle class that had suburbanized with FHA assistance, while affordable housing remained concentrated in urban neighborhoods that were geographically distant from the best economic opportunities. The current debate about zoning reform, which is one of the most active areas of housing policy discussion in the United States in 2025, is directly connected to this history. The argument for eliminating or reducing single-family zoning restrictions to allow the construction of multifamily housing in suburban areas is in part an argument for undoing the spatial organization that the post-war suburban expansion produced and that has concentrated economic opportunity in areas that are accessible only to those with the financial resources to afford suburban housing. The political resistance to zoning reform in suburban communities reflects the same dynamic that resists other reforms to the housing status quo. The residents who benefit from the current arrangement, whose property values depend on the scarcity created by restrictive zoning, oppose changes that might reduce that scarcity and their property values. The homeowners who oppose upzoning in their communities are in many cases the descendants of the families who benefited from the FHA's suburban financing while their neighbors were being excluded, and their political opposition to reform is enabled by the wealth that those programs helped their families accumulate. Understanding this connection between the historical choices and the current political economy of housing reform is essential for understanding why housing policy is so difficult to change, and why the spatial patterns established in the 1940s and 1950s have been so persistent despite the legal dismantling of explicit racial discrimination. The farmer who stood on his porch in Iowa in 1933 could not have imagined the suburban landscape that would emerge from the federal programs that saved his farm. He could not have imagined the racial geography that those programs would produce, the white suburbs and the black urban neighborhoods, the spatial mismatch between workers and jobs, the zoning restrictions that would preserve suburban exclusivity for decades. He just wanted to keep his farm. The federal programs that eventually helped him do so were responses to a genuine crisis that produced genuine relief. And the specific design of those programs, the choices made about who would receive that relief and on what terms, produced consequences that are still reshaping the American landscape and the American economy nearly 90 years later. From the penny auction in Iowa in 1933 to the HOLC and FHA of 1933 and 1934. From the 30-year fixed-rate mortgage to the racial appraisal system. From Levittown to the Fair Housing Act. From the racial homeownership gap of 1950 to the racial wealth gap of 2025. From single-family zoning to the current debate about whether to undo it. That is the complete history of federal housing programs in America. The achievement was transformative, the exclusions were systematic, the consequences are still being lived, and the debate about how to address those consequences is as active and as contested as any debate in American domestic policy. Subscribe if this kind of history is what you are here for. There is a great deal more of it ahead. The final thread of this history connects the Depression-era housing crisis to the housing affordability crisis that has developed in American cities over the past 2 decades, because understanding how the current crisis emerged requires understanding the system that was built in the 1930s and the choices that were made in building it. The homeownership rate in the United States peaked at approximately 69% in 2004, and has since declined to approximately 65%, with a decline concentrated among younger households and minority households. The housing affordability crisis of the 2020s, in which home prices in many metropolitan areas have risen to levels that make homeownership genuinely inaccessible for median-income households, is the current manifestation of structural problems in the housing market that have been building for decades. The rise in home prices reflects several interacting factors. The restrictive zoning that was established in the suburban communities financed by the FHA has limited the supply of housing in the areas with the highest economic opportunity, creating the scarcity that drives prices up. The investment of housing as an asset class, encouraged by the tax treatment of homeownership and by decades of appreciation that has made housing one of the most reliable wealth-building investments available to American households, has increased demand for housing as an investment vehicle in ways that compete with demand from families seeking homes to live in. And the legacy of the FHA's underwriting standards, which shaped private lending practices for decades, has produced a mortgage market that is still less accessible to lower-income and minority households than to higher-income and white households. The young family that is unable to purchase a home in 2025 because prices are 3 or 4 times what they can afford on their income is experiencing the current expression of structural choices that were made in the 1930s and 1940s. The housing near good schools and good jobs is expensive because it is scarce, and it is scarce because the zoning that was established to preserve the character of the post-war suburbs has never been significantly reformed. The expensive housing is owned primarily by older, white homeowners whose families benefited from the FHA programs that created the suburbs, and who oppose the zoning reforms that would increase supply and potentially moderate prices. Breaking this cycle requires either the political will to override the opposition of existing homeowners, which is difficult in a political system where homeowners vote at high rates and have significant wealth to deploy in defense of their interests, or the development of alternative approaches to housing provision that do not depend on the appreciation-based wealth-building model that the FHA established. Neither of these paths is without significant political and practical difficulty. But understanding that the current crisis is not a natural or inevitable consequence of market forces, that it is the product of specific historical choices that had alternatives, and that continue to be made in zoning boards and city councils and state legislatures across the country, is the foundation for making different choices. The Iowa farmer in 1933 needed help keeping his home. The family in a major American city in 2025 who cannot afford to buy one needs help of a different kind, addressing a different dimension of the same underlying challenge: how to make housing, which is both a basic human need and one of the most significant stores of wealth in the American economy, accessible to the full range of people who need it, rather than concentrated in the hands of those who already have it. The federal programs of 1933 and 1934 addressed the crisis of their time in specific ways that produce specific long-term consequences. The housing crisis of 2025 requires its own response, one that learns from both the achievements and the failures of the programs that came before. From the penny auction in 1933 to the HOLC and FHA that followed. From the mass home ownership that those programs created to the racial exclusions that shaped who could participate. From the Fair Housing Act of 1968 to the housing affordability crisis of 2025. The history is long, the consequences are current, and the debate about what federal housing policy should do next is as important as any debate in American domestic policy. Subscribe if you want to keep following this kind of history. There is more ahead. There is one more set of facts that this history demands we state clearly before closing, because they put the abstract analysis in concrete terms that make the human stakes of housing policy unmistakable. The median home price in the United States in 2025 is approximately $420,000. The median household income is approximately $80,000. By the standard rule of thumb that a household should not spend more than 3 times its annual income on a home, the median household can afford a home priced at approximately $240,000. The gap between what the median household can afford and what the median home costs is $180,000, a gap that has grown dramatically since the 2000s as home prices have risen much faster than incomes. In the major coastal metropolitan areas where most economic opportunity is concentrated, the gap is larger. In the San Francisco Bay Area, the median home price exceeds $1 million. In New York, Boston, Los Angeles, Seattle, and Washington, D.C., median prices range from $600,000 to over $1 million. For the median household in these cities, homeownership is not a matter of saving enough for a down payment. It is mathematically impossible at median income levels without either extraordinary savings rates maintained over many years or family wealth that provides a down payment. The generation that bought homes in the 1950s and 1960s with FHA mortgages bought at price-to-income ratios of approximately 2 to 1. The generation trying to buy homes in 2025 faces price-to-income ratios of 5 or 6 to 1 in many markets. The difference is not primarily a product of supply and demand fundamentals. It is a product of the accumulated effect of restrictive zoning, of housing as an investment vehicle, and of decades of policy choices that have prioritized the wealth of existing homeowners over the accessibility of homeownership for new buyers. The young family that cannot afford to buy a home in 2025 is not experiencing a natural economic condition. They are experiencing the consequences of specific choices made over decades by zoning boards, state legislatures, federal housing agencies, and individual homeowners who voted for policies that preserved their own property values at the expense of housing accessibility for younger and lower-income households. Understanding this does not assign blame to any individual homeowner who has benefited from the appreciation of their property. It does establish that the affordability crisis is not inevitable, that it is a product of choices, and that different choices could produce different outcomes. The farmer in Iowa in 1933 needed a federal intervention to save his home. The family in California in 2025 who cannot afford to buy one needs a different kind of intervention, one that addresses the supply constraints, the investment demand, and the accumulated legacy of racially exclusive housing policy that have combined to produce the current affordability crisis. Whether that intervention will come, and what form it will take, depends on the political choices that are being made right now, in the same political system that made the choices in 1933 and 1934 that produced both the achievement of mass homeownership and the failure of racial exclusion. From the penny auction in Iowa in 1933 to the housing affordability crisis of 2025. From the 30-year fixed-rate mortgage that created the American dream of homeownership to the median home price of $420,000 that puts that dream out of reach for most Americans. The history that connects these two moments is the history of American housing policy, its achievements, its exclusions, its long-term consequences, and the ongoing debate about what to do next. Subscribe if this kind of history is what you are here for. There is a great deal more of it ahead. The last word on this history belongs to the specific connection between the Depression-era housing crisis and the present moment that makes the history feel less like the past and more like a continuing story. The family that lost their home in the Depression foreclosure crisis and the family that cannot afford to buy a home in 2025 are experiencing different versions of the same underlying challenge. Housing, which is both a basic necessity and the primary mechanism of wealth accumulation for the American middle class, is inaccessible to those who most need it. The federal government intervened in 1933 and 1934 to address the Depression-era version of this challenge. The intervention was successful in its immediate goal, preventing the mass foreclosure that was threatening social stability. It was less successful in its broader goal, producing a housing system that was accessible to all Americans regardless of race, because the specific design of the intervention embedded racial exclusions that shaped American housing for 3 decades. The federal government has not yet intervened on a comparable scale to address the affordability version of the challenge that exists today. The interventions that have been made, the low-income housing tax credit, various down payment assistance programs, fair lending enforcement, have been meaningful but insufficient to address the structural causes of the affordability crisis. Whether a more fundamental intervention will come, and what form it will take, is the open question at the end of this history. The political conditions that made the 1933 and 1934 interventions possible were the conditions of a genuine social crisis that threatened the stability of the political system. The penny auctions and the mortgage moratoriums and the explicit threats of violence that accompanied the Depression-era foreclosure crisis created the political urgency that made federal action possible. The housing affordability crisis of 2025 is serious and widespread, but it has not yet produced the kind of visible social breakdown that the Depression-era crisis produced. Whether it will, and whether the political system will act before or after that threshold is reached, is the question that the current generation of policymakers is facing. Understanding the history of how the last major federal intervention in housing was designed, what it achieved, and what it failed to achieve, is the foundation for designing the next one better. From the penny auction in Iowa in 1933, to the HOLC and the FHA that followed, to the mass homeownership that those programs created, to the racial exclusions that shaped who could participate, to the Fair Housing Act that ended formal exclusion, to the racial wealth gap and the affordability crisis that are the current expressions of those historical choices. That is the full history of federal housing in America. The achievement was real, the exclusions were real, the consequences are still being lived, and the next chapter is still being written. Subscribe if you want to keep following this kind of history. There is more ahead. The numbers that make this history concrete are worth stating one final time. In 1940, before the FHA had fully transformed the mortgage market, the homeownership rate was 44%. By 1960, it had risen to 62%, driven primarily by the FHA mortgage and the VA home loan guarantee. The white homeownership rate in 1960 was approximately 65%. The black homeownership rate was approximately 38%. The gap was 27 percentage points. In 2025, the white homeownership rate is approximately 73%. The black homeownership rate is approximately 45%. The gap is 28 percentage points, essentially unchanged from 1960, despite 60 years of fair housing law. The persistence of the racial homeownership gap is the most precise single measure of the long-term consequences of the FHA's racial exclusions. The gap was created by specific policy decisions in the 1930s and 1940s. It has been maintained by the accumulated wealth effects of those decisions and by the structural features of the housing market that those decisions helped create. And it has not been significantly closed by the fair lending laws that have been on the books since 1968. Understanding why the gap has not closed, despite fair lending law, is understanding the history this video has traced. The gap was not created by current discrimination. It was created by historical discrimination whose effects have been transmitted across generations through the mechanism of housing wealth. Ending current discrimination does not close the gap, because the gap is not being maintained by current discrimination. It is being maintained by the accumulated effects of past discrimination that are embedded in the wealth levels and the housing locations of current households. Closing the gap requires addressing those accumulated effects, not just prohibiting current discrimination. Whether the political system will find the will to do that is the open question at the end of this history. From the penny auction in Iowa in 1933, to the racial homeownership gap of 28 percentage points in 2025. From the HOLC and the FHA to the Fair Housing Act to the ongoing gap. The history is long, the gap is persistent, and the work of closing it is still ahead. Subscribe if this kind of history is what you are here for. There is more ahead.